All right. Hey, good afternoon, everybody, and thanks for joining us for today's webinar covering the changing face of energy incentives. I know this is it's a big area that we've been doing a lot of work in. It's an area that we didn't really anticipate 2 or 3 years ago that we would be doing a lot of work in, but that was something which was spurred by the Inflation Reduction Act, which we're going to cover. But we are seeing a lot of new clients and different clients than we may have seen 3 or 4 years ago. So a lot of exciting topics to cover, a lot of things on the agenda here in a fairly quickly moving area of the tax world. So just as a high level agenda, here's what we're planning on covering. So we're going to cover just a general overview and review of the Inflation Reduction Act and the energy and climate provisions of that. We want to cover some of the energy updates related to Section 179D deductions and energy efficient commercial building deductions, legislative changes related to energy, and something that's been getting a lot of press lately, which is executive orders, and the potential impact that those may have on some of these programs. So there's going to be a little bit of crystal ball reading that comes along with that. I want to cover statutory versus discretionary incentives. Section 48 and 45, now moving to Section 48E and 45Y now that we're into 2025. And then we're going to close it out with monetization of renewable tax credits. So getting into the 6417 elective pay and the 6418 transferability of these credits. This is who you're going to be speaking with today. So myself, I'm Phil Williams. I'm a partner, former operations director at Tri-Merit, now moving into more of a technical development role. John Capral, who is a vast resource for knowledge as it pertains to all of these incentives. But I don't want to say all. I'll cover in a second. A good number of these incentives that he has a deep background working with. John's also a tax attorney, deep background in tax. Barry Devine, who's going to follow up toward the end, cover some of the transferability and monetization aspects with credit. So the three of us speaking with you today. Just from an administrative perspective, this session is going to be eligible for CPE. So the requirements for that is that you have to stay on for 50 minutes. There's going to be some polling questions that are going to come up about every 11 or 12 minutes. So long as you're able to answer 3 out of the 4 of those, then you should be able to get the CPE. Those certificates will be mailed out usually about 48 hours from now. As we're going through, if you have any questions, please feel free to throw them in the Q&A. So when we're not speaking, the others of us will be in the background trying to answer those as best we can. If we can't get you a real-time answer, it's something that we can certainly follow up on. So jumping into it, renewable energy incentives. What is the Inflation Reduction Act? I'm sure we've heard a lot about it. I know we've done a lot of speaking about it. This is something that came out in August of 2022. The intention was to reduce carbon emissions, so to put incentives and regulations in place that would get us to, at that point in time, what was viewed as the place we wanted to be carbon emissions wise. So a reduction of 40% by the year 2030. There were a handful of other things that were included within this bill. I've always liked the graphic off to the side, which talks about what was the spend going to be on this. Early on, the anticipation was that the investment was going to be somewhere in the $300, $400, $500 billion range. Very quickly, that escalated, and some of the larger banks and groups that were speaking on it, upped that estimated investment into the $1 trillion+ range. So significant investment, significant amount of money in play, and something which unfortunately there's been a little bit of uncertainty introduced into, which again we'll cover, but big deal. Think of it along the same lines as spending wise as the Transcontinental Railroad, or the anticipated impact from that was anticipated to be that large. So what was covered in this in terms of the energy and climate provisions? There was a laundry list. There were things as simple as putting new energy efficient windows on your home, putting up residential solar. There's a lot of things that we probably see day to day and don't really recognize them as something that was covered under the Inflation Reduction Act, but those were covered. And those are relatively simple transactions, all the way up to much more complex transactions, getting into nuclear, getting into utility grade solar and wind that were covered. And really where we find ourselves spending most of our time is somewhere in the middle, working with manufacturers on Section 48X credits, or 45X credit, sorry. And then working with taxpayers that are going through and are making significant investments in renewable energy items like solar, like geothermal. And those are things that are covered now within the new 45Y and the new 48E. So that's the area that we found we can add the most value, or we can help people the most, is along those lines. But understand, very, very broad program touching on a lot of areas. So what I want to cover first, I'm going to cover two things. So Section 179D and the energy efficient commercial building deduction. And then I'm going to go into some of the executive orders and the way that we're reading them and the position that we're taking as far as what the short-term impact of those is going to be. So starting out with Section 179D, there have been some significant changes to this. And those significant changes are creating considerable opportunities for those that are planning correctly around it. So to give you just a high-level basic background on what Section 179D is, it allows for enhanced deductions on energy-efficient commercial building properties. So if you're putting up a new building, or if you're retrofitting or improving a building, putting in new air handling units, putting in new chillers, putting in a new roof, putting in new insulation, doors, windows, all of that factors into the equation. And what happened with the Inflation Reduction Act was it changed a couple of things. It changed the standard against which the new buildings have to be compared. Now we're dealing with the new and updated ASHRAE 90.1 standard. It also allowed for increased deductions. So we'll get into the math of that in a second. But really what it allowed for is if projects met prevailing wage and apprenticeship guidelines. So if the contractor or the builder of the property was paying the appropriate level of wages, was paying the appropriate level of fringe benefits, and probably more crucial, if they met the apprenticeship requirements, then there's a potential 5X bonus that comes along with that. So we've seen a lot of companies that have been able to take advantage of that, either by proving out the prevailing wage and apprenticeship, or there was a clause where when the law was being hashed out back in late 2022, there was a notice period, and until that notice period had run, and until 60 days after that, there was I'll call it a grandfather or automatic qualification period, where if construction began prior to January 29th of 2023, and maintained construction consistently throughout, then you were allowed to automatically qualify. What that does, the bottom two bullets, it takes it from being a base deduction of anywhere between 50 cents and $1 per square foot. And these numbers have all ratcheted up over the course of the past 2 years based on some inflation adjustments. But it takes it from that 50 cents to $1 per square foot, where by having the increased benefit, you go all the way up to $2.50 per square foot, up to $5. Or you'll hear it referenced a couple times a day, for 2024, up to $5.65 per square foot. What's significant here, and it was actually covered on the last slide, this is a significant incentive for building owners. It's an even more significant incentive for those parties that can receive an allocation of that depreciation. So what does that mean? That means that if you have a government building, or if you have another not-for-profit taxpayer, church, private school, anything along those lines, hospitals, because they're not taxpayers, they have no usage for those enhanced deductions. What they can do is they can then allocate that accelerated depreciation to the entities that contributed to the energy efficient design specifications on the property. So could be an MEP engineering firm, could be an architect that designed the building envelope, could be consultants that were contractually obligated to contribute to those design specifications. So again, that's an area where we're seeing a lot of folks that are able to take advantage of this, really reduce their tax liability based on those allocated deductions. I touched on this. I went a little bit out of order with the slides because prevailing wage and apprenticeship is so significant. But I think if you were to take this and you were to boil it down to a plan, then it would be to get out in front of it. If the building, if the general contractor is going to use prevailing wage labor, then they need to be tracking it. They need to be keeping track via the labor submissions to the DOL. And they also need to be tracking that apprenticeship requirement. There are some cure provisions that can be followed. Let's say if the apprentice hours ended up being a handful less than they needed to be, there are cure provisions that are there, but by planning and getting out in front of it, it's a little bit easier to qualify for those enhanced deductions. want to give you 4 examples just to share some math behind what this looks like and really show the benefit behind proving out that prevailing wage and apprenticeship labor. Example 1 and 2 are both a 50,000 square foot building. Example 1 does not have prevailing wage and apprenticeship labor. Example 2 does. So same building, you look at going through and doing a study, and at the end of the day, in example 1, the net benefit for the client ends up being somewhere between $2,000 and $8,000. And example 2 ends up being between $23,000 and $53,000. So really magnifies the benefit there when you're able to establish that prevailing wage and apprenticeship labor. And we got 2 more quick examples. In this one, 100,000 square foot building. And again, we're making some assumptions here. It's a C Corp, 21% tax bracket, et cetera. But again, in example 1, no prevailing wage and apprenticeship, still a good benefit between $8,000 and $16,000. But in example 4, smaller building, does meet prevailing wage and apprenticeship, and you're actually able to get a bigger benefit out of it. So there are some hoops you need to jump through. There are some documentation requirements which can be challenging to meet, but if you're able to do it, there really is a significant benefit at the end of the day. So I'll shift from that to, 170 is not a new thing. It's been around since 2006. Still a significant benefit there, and we see a lot of people that are taking advantage of it. The current landscape with renewable energy incentives, and this is something that I'm sure everyone has caught snippets of on the news, on social media, but there was a large number of executive orders that were released back toward the end of January. And one of those executive orders was referred to as the Unleashing American Energy. So Barry, if you want to skip to the next slide, what that did was it talked about what the current administration's aim was going to be. It was going to unleash American energy, whether that was via oil, natural gas, coal, hydropower, biofuels, etc. It was taking a close to 180-degree approach from where the prior administration was. And the wording of that executive order was that it was tasking the individual departments with going through and seeing what programs were in alignment with the executive order and which programs perhaps are out of alignment with the executive order. And it talked about grants and it talked about disbursements. And really what it did was it caused uncertainty. And there still is some uncertainty, because even though when you evaluate this and you evaluate the terminology behind it, you break down the words, our position, Barry, if you want to skip to the next slide, our position is that the tax credits which were granted under the Inflation Reduction Act are statutory incentives. They're not direct appropriations. They're not discretionary funding. So it is our belief that an executive order cannot directly impact the legitimacy of these claims. However, some things we need to keep our eyes on are current litigation around them, the potential that Congress may take this up and may make some tweaks or may make some changes to the Inflation Reduction Act and some of the programs. You'll see that the polling question is up right now, so if you might give an answer to that. So we're recommending that folks keep their eyes on it, and that we pay attention to the news and we see how this progresses over the course of hopefully the next couple of months. Because again, what we're hoping for is some certainty. We're hoping for something that folks can rely upon and not be in this area of uncertainty and not knowing what may happen for 2025, 2026, and beyond. We're pretty comfortable that anything that was claimed and earned in 2024 eventually will be paid via the tax credit method. So I'll stop there. I'm going to hand the baton over to John to cover some of the DOE funding opportunities and really what we're losing via some of these executive orders.
Well, good afternoon, everyone. Nice to be here and glad to have you here with us on this very important topic. Presumptively, we're talking about the energy incentives and credits focused that have come from IRA that are effective as of January 1st, 2025. There are some collateral issues. Of course, Phil touched on those and got into some of the reasoning, some of our position on these very important incentives and credits. Main takeaway being the statutory credits because they're statutory, they remain law, regardless of any administrative executive action, pending pending congressional action, which not to underestimate the power of that. We are in that period of time right now, in the budget reconciliation time, where there are ongoing discussions on, and actually a budget has been passed, and that budget now is going to be detailed over the next several months, and what remains of IRA, what remains of the infrastructure bill. Those are the two primary sources of law for the energy incentives and credits, is to be determined. And so that's where we are today. We want to show you a few of the DOE funding opportunity programs that were available up until recently. Some still are. There are some that are suspended, some that are attempted to be terminated, others that are still going forward. And so we want to at least give you those reference points. Two in particular I'll talk about because they were very important and high profile and still have some opportunity. One being what was called the REAP program. That's the Rural Energy and it was a solar focused program that would provide up to a 50% grant through the USDA for a solar project. That has been terminated. However, there is still a program that's potentially available through the Farm Bill, and this is a 25% credit for solar installations. This may or may not be the case in time, but at least this was something that did survive. And it doesn't mean that there might be some additional or revised or new program relating to agricultural solar. Very important, especially at a time where there's a struggle by the farm communities with the impact of tariffs and such. And so we may see some of that come back in some way. And again, that's to be determined through the budget reconciliation and the tax bill negotiation process over the next several months. The second program that I'll highlight was very important for the EV charging network, and this is called the NEVI program, the National Electric Vehicle Infrastructure Program. This was not an IRA program. This was an infrastructure bill program from 2021. It was a 5-year program, $5 billion allocated to the states. That's a main difference between REAP and NEVI. REAP was managed through the USDA, government agency, federal government agency, where NEVI is a state administered program that does report to the Department of Transportation, and states were required to provide a plan on how they were going to develop their EV infrastructure. That's been one of the sticking points on EV installation projects, and the money was distributed maybe about 60% of that $5 billion. So it's already with the states. Projects were in various states of progress. Some were completed, some were under contract, some were in negotiations, and others are still pending applications. And so that's the range of potential projects. So the money that's not been dispersed is frozen at this point, and that's through the executive orders. The money that's been distributed is being used. There are some states that are deciding to refrain from any new applications or any process moving forward, any progress on a wait and see basis. Other states are actively engaged in getting their NEVI projects in the ground. And so that's where that discussion comes from, if you hear anything there. So the way that these grant programs work, these were not tax credits. These were appropriations. And so this is a different animal, and this is subject to review. However, as an appropriation, these are the challenges that are being discussed, and where there may be some litigation soon. There may be some movement there. We just don't know. But that's the difference between those programs and the credit programs, the up to 30% credit with adders. The grant programs, as you can imagine, were a very important part of the capital stack of these energy projects. And so you would have your private money, you would have your grants, whether it was REAP or NEVI, which could be up to 50%. They were both very generous. And then you'd have your credits on top of that. And so you see these projects there was a lot of pull to these projects to get them in the ground. And that's slowed down. Doesn't mean they're going away. There'll still be private investment. And so what that gets us back to now is the tax credits, the statutory scheme of credits that are still on the books, still valid law, and subject to this budget reconciliation and tax reform process that we're engaged in right now. So with that, I would like to introduce Section 48 Cap E and 45 Cap Y. These are the new effective provisions that were part of IRA, passed in 2022, but effective in a springing manner. In other words, effective January 1st of 2025. It modifies the regime of qualifiers for the credits. And the philosophy here is to move toward a technology neutral, in other words, not picking winners and losers, technology neutral way of generating or developing clean electricity, and this is interesting, also energy storage technologies to enhance the ability for new energy storage technologies. These can include things like your typical electrical storage, thermal storage, which is unique and new. It's been around a long time, but to be a focus of the incentives and credits is a nice opportunity. And also hydrogen viewed as a storage mechanism. So there's a great deal of interest here in the clean electricity generation under a clean electricity facility, and also the energy storage technologies. And so those still exist. The main changes are there's a severance from any greenhouse gas emissions. That's a qualifier here. Net zero emissions is the term of art that's used, and so it's those projects that are net zero emission generators can qualify. And by this list here, obviously solar, wind would be your primary types of qualified net zero generators, and then hydropower that would be obvious as well. It's when you get into some of the cogeneration type electricity generators. That's where you now find those would not be qualified today. Some others that simply expired, microgrids and electrochromic glass, which we saw some of, which was very interesting, since buildings and structures are a very important target on leaching energy just through windows and such. And these electrochromic glass products can mitigate that and minimize it. And so that's what we're seeing in the new regime as of January 1st. And again, these are still in the tax code, statutory credits, and that's how we're pursuing these with our clients. And our clients are developing projects with those assumptions as well. A couple of things. You're also allowed for your qualified facility to include interconnection costs as qualified property. They're not energy or electricity generators, but they're tangential and important to transmission and distribution. And so they are separately included on smaller projects up to 5 megawatts. But they're not available for the EST systems, unfortunately, the battery storage systems, just for the clean electricity generation. These rules also will apply to retrofits. So if you've got a reconstruction, a project that you're adding qualified property, clean electricity generation property, a solar array, for instance, that can qualify if no more than 20% of the basis is the old property. And so typically you're going to be getting up to 100% of your energy property with a solar installation, as long as you're not reusing or repurposing existing tax basis property beyond 20%, that project can qualify also. One other change from the previous regime of Section 48 and Section 45, and by the way, 48 relates to the ITC, the investment tax credit. 45 or 45 cap Y relates to production of electricity to be sold to third parties. And so, but the fundamentals are the same. So this idea of aggregating projects into one project for tax reporting purposes was a nice feature under 48 for the ITC. Under 48 cap E, it's not allowed, unfortunately. You've got to do this project or unit of the term here is we're talking about is a unit of qualified property or a qualified facility. And so that's what we'll talk about here for a couple of reasons. One, this is how you determine your tax basis for what will qualify for the credit. It also serves this purpose of segregating or separating out different facilities within the same project. And the reason for that is, and this was in the final regulations that came out recently, it was clear that this aggregation is not available. And so it really primarily goes to the prevailing wage rules that Phil talked about earlier. Each facility now, each qualified facility on a project must stand alone on its own to get the additional credit to move up from the 6% to the 30% credit. It must qualify under the prevailing wage rules if those rules apply. And the exceptions are similar to the existing rules. Up to 1 megawatt was the main one. Also, if you've got a project though, and this is the other side of that coin, for some reason the aggregation rules do not allow you to bring all of your projects into one qualifier for your PWA and also the other adders, domestic content, energy community. You've got to look at those qualified facilities separately, even though it's one project. The downside of this, though, is when you're determining that 1 megawatt threshold, you have to aggregate these other projects, these other qualified facilities within the project. And so it's sort of a whipsaw effect that not clear why that's as it is, but it is a rule that we've got to be considering when you're doing your planning and project development, because you're going to need to plan to have your labor and apprenticeship rules apply to all of your qualified facilities if you want that added to the 30%, and also the domestic content or energy community rules will stand alone for each of these qualified facilities. So a qualified facility, a unit of a qualified facility would be this functionally interdependent components, the parts that you need to make it work. And this would also need to be owned by the taxpayer and then operated together, but they can't operate apart if it's designed that way, but they can still be considered part of this qualified facility. There's another aspect of Section 48 Cap E. You can include integral parts. This is something that's used directly within the intended facility, the intended function of the facility. That's essential to the completeness of the function, and this can include elements that that are in the regulations, conditioning and transfer equipment, but it would not be considered part of the unit of qualified facility. It's an additional included component, and the importance of that is, again, applying these rules separately for some reason was desired by Treasury. One last thing here, and this is a chart we put together to map out this idea of determining what exactly is a qualified facility. In the proposed regs, it was not clear what this meant entirely. Is the facility, for instance, you put a solar array on a manufacturing building, and is that a qualified facility, or is the entire building a qualified facility? Of course, if you're counting the entire building as the qualified facility for this purpose, if there's gas-fired HVAC system, that can cause you to fail the net zero emissions aspect or element requirement. So that's where these regs were important to get some refinement, and we have, in our determination, determined that concluded that that example of a solar array, the facility, the qualified facility itself, is that solar array, and so that's where we would limit our evaluation for the net zero emissions test. There are other complexities that are more arcane to the 48 Cap E, the 45 Cap Y rules. We have final regulations. At least these did come out the first week of January. However, they do remain subject to rescission or amendment as they are regulations, and so those could change without statutory action. That is one final note that I'll just mention. And so that, again, we stay involved in this process for those reasons, to keep abreast of these latest and greatest changes and proposals. One highlight today, the White House is having a summit today with oil and gas industry, and this is very interesting to us, as it should be to you. Oil and gas industry does have some vested interest in retaining parts of IRA. They do favor the alternative fuels regulations and code sections. These are for hydrogen fuel, biofuels. They also favor the carbon sequestration rules, because these are credits they've been taking advantage of for many years in their pipelines and structures, and so they want to retain that as well. And so there is some push from oil and gas industry to retain some of IRA. There's also congressional support. There are 21 Congress people who have signed on to a letter to the House Ways and Means Committee last week, up from 18, and they're encouraging a careful review and analysis before IRA is repealed, amended. Some of these provisions are very important for their constituents in their jurisdictions, and so we do have some belief that there will be political pressure to retain significant parts of IRA, but that, again, is to be determined. Barry, I'd like to hand off to you.
All righty. Thank you so much, John. That was extremely informative and in-depth, and you and Phil gave me a good amount of time to talk, which is fantastic because I like to talk. Okay, so we're talking about what's discretionary appropriations, funds, loans, grants. That's money on the front end. getting the projects financed, designed, built, placed in service, statutory with the tax credits. So what we're going to do now is we're going to just kind of do a highlight of what, just very quickly, the calculation of the credits, and then go into the last mile, the utilization, the taxpayer benefit of the tax credits in that going into the monetization. So really quickly, to back up a little bit, from 45 going to 45Y, 48 going to 48 cap E, 45s are your production tax credits. You're generating the electricity, you're selling it, you're making the money every year after the electricity is generated. There is 45X, that is the advanced manufacturing. So that is making the eligible components for, wind, solar, battery, and critical materials. And then what we see the most of is 48. Those are the ITCs, the investment tax credit. That is the first year I spend $1 million, I got a 30% credit. I got my $300,000 in tax credit this year. And there is a 5-year recapture on the ITCs going forward, but this is mainly what we've been seeing. Anything under 1 megawatt, 30%, over 1 megawatt. And we had a slide in the 179D section on prevailing wage and apprenticeship because it is just very critical. It is. So you also think the PWA is on the side of a lot of these credits, and it's just a 5X multiplier for 179D, 45L, energy incentive credits. It's a 5X multiplier. And it's kind of its own beast in how you become compliant, how you substantiate, how it's going to be tracked and substantiated is very, very critical. So 6% to 30%, and of course the bonus adders. We have an entire other 1-hour webinar on domestic content, energy community, and low income community. So they are great. They are see the prevailing wage as well. It's either 2% or 10%, whether you're meeting the prevailing wage. So that being said, they are very fantastic adders, not without the lack of effort and to substantiate. So the PTCs, again, on the right side here, 45X, that is your advanced manufacturing credit. That is, manufacturing for the supply chain of solar, wind, battery, critical materials, and minerals. The left side is the technologies, the highest technologies of PTCs that you're going to see generating, selling electricity through the generation, wind, solar, geo, hydropower. Those are your top technologies. On the ITC side, there's ITC for wind, solar, geothermal, energy storage, like John mentioned. That can be the battery storage. That's a electricity storage. There's thermal storage. We see a lot of thermal storage. So the top technologies that we're currently working with, I think the number of projects we have the most number of solar projects. Maybe the biggest dollar amount is geothermal. We do see a lot of energy storage. There's battery components, but there's a lot of thermal energy, buildings putting in chillers. And that's actually why we did the 179D componentry, just because, we're seeing a lot of C&I, which is the commercial and industrial applications, putting in thermal storage units. So we see energy. We have biogas projects. We have combined heat and power and waste energy recovery. So those are the main technologies that we're seeing, that we're working with on the ITC side. So that being said, going into that last mile, another polling question coming up right now. We are just coming up on 40 minutes after, so got to hang with us for another 10 minutes, and I should be able to fill that time with what, the last mile, the monetization, the usability, what is the application of these credits, and how does a taxpayer actually use these credits? So again, backing up, there's discretionary appropriations, funds, loans, grants, funding the project, placed in service. The project is placed in service. We're calculating that credit, 6%, 30%, 40%, 50% of the eligible basis. What is an integral part? What is functionally interdependent? getting your qualified basis for the actual project, what's qualified, multiply it by that tax credit. Let's say, for the example, we spent $1 million on a solar on the roof, and we have a $300,000 credit. So what are the options, right? There's basically three options. One is you're a for-profit entity and you're going to use the credit. You have tax liability. There's just like, WOTC, 45L, R&D. These are 3,800 general business credits. That's the mechanism for getting it into the taxpayers' tax return. So if you're going to use the credit, the 3,800, these credits going to go, you utilize the first year. If you don't have enough tax, it'll go back 3, 2, 1, and then it goes forward 22. Kind of like the R&D tax credits, back 1, forward 20. This is back 3, forward 22. Those are for-profit taxpayers. If you're a for-profit, you can also sell your credit, which we're going to get into in just a minute on what that looks like. I got a few examples of some credits that were sold and what the process looks like and what are the factors involved in that. You have to have an unrelated taxpayer, open tax returns plus extensions. It can't be an amended return, and you make the exchange. I'll get to that in a minute. But if you're a for-profit taxpayer, you're going to use it or sell it. The other side of that, if you are not for profit, if you are a municipality, right? There certain applicable entities we'll get to in a minute, they're going to use what's called direct pay. And this is where you're going to do this through the 990T, and you're a not-for-profit. You calculate this tax credit. Yes, you do the form, which would, in this case, would be a 3468 and a 3800, which if you're not-for-profit, 3800s are, very foreign because they don't have, general business credits. 3,800 over to the 990, and this is where a refund comes back from the government. So what we have realized doing this is in the feasibility process, right? You got your loan, you got your funding, you got placed in service. When even in the beginning, when especially the not-for-profits, before you're pulling the trigger on spending this money, the client, both for-profit and not-for-profits, they want to know the end game. They want to know what's the client journey. If I'm going to spend this money and place this in service, I understand I'm going to get, my electric bill is going to go down, but what does all this other mean as far as my tax credit? So what we try to do is we do the feasibility in the beginning and say, what is your monetization determination? What are you doing? What technology? When does your tax year end? For profit, not for profit. This is what that's going to look like for you. And then of course, the IRS portal, the due diligence package, the monetization at the end. So I'm gonna jump into some of those. So again, what's law, what's not law, what's discretionary, what's statutory. 6417. These are the rules for the not-for-profits, right? Tax exempt and government entities, tribal governments can benefit from tax credits with a refundable tax credit. That's all under 6417. There are a few programs, 45X, 48D, that if you are a for-profit, you can also get this money refunded utilizing direct pay. So there are some limitations and considerations for this, or if there's bond financing, domestic content requirement, there's going to be a 10% penalty starting. So there's a lot of little nuances into it, but the most common projects we see not-for-profits are schools, churches, hospitals. It's just been I got some examples in here. It's been a really, really excellent program to help these not-for-profit entities navigate, what's going to qualify, how does it qualify, what's my basis, how do I get on the portal, what's the registration number, 3,800, and then all the way to 990T to check in the mail. It's been really, 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 really awesome work. So the applicable entities, U.S. territories, instrumentalities, rural electric co-ops are in there. Any tax-exempt organizations, state and political subdivisions, local governments, Indian tribal and Alaska Native corporations. And this is the process for not-for-profits. Qualification, placed in service, what's that client journey look like? IRS portal registration. That's where you the IRS wants to see 120 days from the time you register to the portal, from the time you actually receive that registration number that goes in the tax return. All of the due diligence process, make the elective pay election. Again, that's where, in this case for the solar, it'd be 3468 to the 3800 to the 990T, receive a check. That's the process for not-for-profits. This is a little glimpse into the portal. Got to have a representative from the organization, ID.me account, and you got to register your intent. What they did is they took the Inflation Reduction Act and the CHIPS Act, and they created its own portal in order to walk through to get the registration number in order to file. This is both for IRA and the CHIPS Act. It is both for elective pay and transferability. The process looks very similar when you go through. It's just one is a P or one is a T, whether you're going to be elective pay or transfer. So that's what the portal is going to look like. Just a little news here that came out. RevProc 2024-39 was, if you are a CPA or you're working with not-for-profit clients, the IRS understood that a lot of not-for-profits are not going to fully understand what this means, or I have to file, or when do I file? We found a lot of not-for-profits don't file 990s at all. Some file 990s, some file 990T due to unrelated business income tax. It was just kind of all over the board. So the IRS understood, hey, filing for an extension may or not be on the radar. So what they did is they provided an automatic 6-month extension. And so recently this RevProc said, hey, don't forget all the applicable entities, not-for-profits, any tax year ending after November 30th, 2024, you don't get the automatic extension. So if you're working with not-for-profits, the due date 5 months and 15 days after the selected into the tax year, it used to be automatic 6-month extension. Now you will have to file an extension. So anything prior to November 30th, 2024 automatically has 11 months and 15 days in order to file elective pay. Now it's time to start paying attention and file for extensions, because you can only take the elective pay on a timely filed return. So good to know. Okay, a couple examples. Again, never in the 20 years of doing this did I think I'd be doing tax credits for not-for-profits, but this has been really, really awesome work. Just so good to help these, not-for-profit entities, get to the realization of the money. They know you get the bond financing, and you have a board, and you collect the money, and you're like, okay, we want to pull the trigger, but we're an Illinois school district, and we're about to, spend $6 million on an improvement. And so in this example, we did a project for Illinois school district. It was a $4 million spend on a geothermal heat pump and wells. And it was really awesome renewable energy option for the school and helping them navigate it. If the eligible basis, like I told you, what's integral, what's functionally interdependent, what's the cost segregation breakdown on all of these costs. If it's $4 million eligible basis, we took a 30% ITC for $1.2 million. They got a domestic content bonus. They were not in the energy community, did not have an adjustment for bond financing, and their federal credit in the form of a refund is $1.6 million. And it just, it's just awesome work. It is great. Here's another Lutheran church in Texas. They spent $500,000 in solar PV. They had $165,000 credit. They were in an energy community. They're getting a check for $220,000. Here's a local government. This is up in Wisconsin. Small solar system, 347. They're getting an $88,500 check, and they're over the moon on that amount of money. It's just fantastic. And then, larger hospital up in Minnesota. This is a cogen system. This is a combined heat and power project, larger project, $30 million in eligible basis cost. No PWA because, greater than, 5% of completion prior to January 29th, 2023, because it was a big program. And again, what is an integral piece of it? What is functionally interdependent? Like how, what is the qualified basis? How do we get there? And that's what we do. That's what we love doing. So large credit for for that hospital. So now moving over, change one number from 6417 to 6418. So now, the other side of the monetization piece, you're funding, designing, installing, place and service. Not-for-profits are going to go down what's called the P track. You're going to be elective pay for a refund. If you're a T in the portal, that means you're going to be doing the transfer side. So use a credit. If you're not going to use the credit, sell a portion of your credit, sell one credit to multiple buyers. But anyway, 6418 is the tax credit transfer, transferability, credit exchange, buying and selling, whatever you want to call it. These are the rules for how it all works. There is a big warning from the IRS because they're not wrong, but after PPP and ERC, they're tired of the scam. So they're saying, look, buying and selling tax credits, buyer beware. And there's a few rules that they put in place in order to try to combat some of the scam. So C Corps can offset their income tax. If it is a flow through, it's going to offset passive income only. So the S Corps and partnerships flowing through, not going to offset income tax. It's going to have to be passive income tax. That was kind of a result of, having a warning. So has to happen on an open tax return. Here's the process. Looks very similar. Credit, process, electronic filing, due diligence, and then you're going to arrange a credit. So instead of a 990T, you do a transfer election statement. You find a buyer. Transfer election statement, 3468, 3800, registration number. And then the buyer is going to put it in there, 3800, and make the transaction happen. So again, credits, statutory credits available, 48 Cap E. Okay, last polling question up. We've got about 9 minutes. I'm going to walk you guys through the end of what this looks like. Yes, you can get tax credit insurance on your credits. Anything under $5 million is hard to get tax credit insurance on because of the size and the cost of insurance. The type of credit is going to be is going to determine what the price is. ITC is going for 85 to 90 cents on the dollar. PTC is going for 90 to 93. Some are going to go to 94, 95, just depending on the type of the credit, market demand, risk and compliance, the technology, what's the due diligence, right? And then the transaction fees and administration. So what does that process look like? There's eligible property, right? That's the asset. There's eligible tax paper and there's eligible credit. Those three things together are all on the sell side. And this is an ITC example. So the transferee becomes the buyer. So, the fact that the transferee and the buyer is called the buyer, air quotes here, but the IRS looks at it as if there is a 5-year recapture period or one of these is going to get audited, the IRS immediately goes to the taxpayer, right? So then the taxpayer is the buyer, the transferee. So buying the credit takes their 5-year recapture risk on the buyer. That's why there's insurance, and that's why there's due diligence, and that's why you want to make sure you're buying the right credit. So cash goes to the seller, the 3468, 3800, registration number, all in the 3800. That information with the transfer election statement to the buyer. It has to be an open return plus extension, not amended. So really quickly, here's what a credit kind of looks like. There's a combined heat and power system, $3.9 million credit. This is what you'll see a sell sheet look like. There are credit exchanges out there. There are people buying and selling credits. It's going to be a pretty big marketplace coming this year. If you do have clients with tax liability, tax obligation, looking to buy credits, it's a little bit of buyer beware. Make sure you know who did the due diligence. Make sure you have all the answers on who holds the lease and who, what's the debt, what's the financing, what's the technology, what's the location, what does it look like? So there's a lot involved in just the actual matchmaking process, more than just saying you get you 90 cents on the dollar. So some of the deliverables, due diligence package, again, the forms, a transfer election statement. And then looking for buyers. This is what this will look like. You can take one credit to multiple buyers. You can sell a part of your credit. You can, there's different things, there's different choices. So if you generate a tax credit and you have some tax, you can offset that tax. You can sell the rest. So let's say there's a renewable asset here. This is a geothermal project. Here's all the due diligence in the package. If it's a $10 million eligible credit, in the middle, there's that tax credit transfer agreement. That's the agreement between buyer and seller. Buyer and seller contracts, right? There's placement contracts. There's buyer representative contracts, seller representative contracts. There's insurance, recapture, and then the transfer administration. This could be broken up if there's 5 different buyers with different levels of tax appetite. This registration number in 3800 goes into 5 different 3800s with the same registration number, which is how the IRS is going to audit these. They're going to get the registration numbers in the tax returns, and they're going to try to match them up and say, if I see this registration number 5 times, it needs to equal the amount of this credit. So this is what the process kind of looks like, really, really high level. And then there's 4 minutes left, and I just wanted to kind of close out on, again, there's a lot of moving parts. The IRA was a very large piece of legislation. It did enhance and renew a lot of older legacy programs, both on the discretionary side and on the statutory side. So currently, we're trying to share, especially with all the changes in the administration and everything else right now, we're trying to kind of keep it as chronological and succinct as possible this is on the front end, this is the loan process or the funds and the grants and, like the appropriations process and what that looks like. Are the funds there or not? These are the credits that are in place. These are the new statutory credits in place. This is how monetization works. And when you look at this, it's also holistically of like ITCs and PTCs, you got to choose one or the other. If you are advanced manufacturing, 48 Cap C or 45X, you cannot take the other energy incentives. When the reason we put 179D in here is because we're seeing a lot of, like, if it's geothermal or thermal energy storage and an HVAC upgrade, or like John mentioned, electrochromic glass, if there's lighting, HVAC, what we're seeing is a lot of expansions, right? You need a cost seg study on your expansion. While you're expanding, are you choosing renewable energy? Are you going to do geothermal? Is there thermal energy? Is there battery storage? So even one build out that might need cost segregation could also have renewable energy, which could also qualify 179D, energy efficient commercial building deduction. The cost seg and that 179D are both going to affect basis, and how's that going to work? And if you're looking at a lot of these, if you're for advanced manufacturer or some of these other developments, the research and development tax credit is going to come into play as well. So looking at, building asset, what is the building? What is the asset? What might qualify just based on the asset, right? I have a build out, I have energy efficient, I have solar, I have geothermal. These are happening. What are the activities within your building? Are you creating new products or processes and formulas, inventions? Then, so all of a sudden we're potentially cost seg 179D, renewable energy or R&D, or are you making widgets? Do you need a domestic content verification study? Like, there's just a lot of different. There's a lot of interplay with the various credits and incentives. And so when you have a client, it's good just to understand what is the asset, what are the activities, of course, what is the funding, what is the timing, what does that final result look like, and how is it monetized? So trying to bring it all together, that's all the time we have. Just wanted to say thank you to everyone who joined today, and we'll be in touch. All right. Thank you.